right, well, welcome. My name is Jason Watson, managing partner of WCG Incorporated. We are formerly Watson CPA Group. I'm here with Quentin Leighty, First National Bank of Monument. We're hosting our Bourbon and Business, sorry, I'm gonna mess that up, Bourbon and Business series for our podcasts. We're at the Axe and the Oak here in Colorado Springs, and they're gracious enough to host us. In our previous segment, we discussed your role in the bank and also community banking. Can you just kind of summarize that again for us real quick?
Sure, yeah, I'm the CFO of the bank, president of the Monument and Flying Horse offices. I do manage a loan portfolio, and we're a community bank that's been around 118 years and going strong and really focus on small business in the state of Colorado.
Yeah, that's awesome. So we talked last time about the Federal Reserve and how your bank's older than the Federal Reserve. So I just watched Hamilton for the first time ever, and learning how much of our banking and our financial systems came from Alexander Hamilton. So it's kind of neat.
Yeah, it's pretty cool. We actually have, this is a little known fact too, that we actually printed our own notes before the Federal Reserve took over printing all the federal currency.
Money? Really?
So we have in our main office, we've got notes that were printed by the First National Bank back in the early 1900s.
That's cool.
So pretty cool.
Yeah, I bet that's valuable. Like from a
They are. Yeah.
Well, that's great. Well, hey, thank you for joining us, Quentin. And we're talking about community banking, how it relates to business owners. This is the Bourbon and Business series, so we might as well talk about business banking, right? Tell us a little bit about how somebody qualifies for a loan.
Sure.
That's probably one of those general questions. You can talk on for forever about it, but just tell us some of the basics.
Yeah, we look at financial statements, and so those, hopefully they're working with the CPA firm to put those together, or they have someone on staff that really understands their business and what they do. So we're looking for net worth within the business and the individuals that are backing the business, that are the owners. And then tax returns are a big piece of it too. We use that for the cash flow analysis. A lot of times I think that makes small business owners nervous, but what we're doing is we're going in and adding back cash flow. So things that you can expense that the IRS allows, we'll add those back in certain scenarios like depreciation, amortization, so that we can strengthen their cash flow so we get a true picture of how much cash are they generating, and then match them up with the right debt product that's a good fit for what their capacity is.
Yep, and when we do business valuations, we look at the same thing. Seller discretionary cash flow, we look at owner compensation, we add that back in as well. Depreciation, amortization, interest expense, all that. How much cash is this business generating?
Right.
Ultimately is what we're looking at, not net income, although we might begin from there, but we're, like you said, piling on a lot of those deductions and expenses that the IRS allows. So
that's right.
What happens, and I'm sure it's not the first time, when a tax return doesn't match up with the financials? Because the financials are built for maximizing value on some levels, and tax returns are built to minimize tax.
We do try to understand where the differences are coming from. A lot of times, though, the tax return is cash-based. And if they've got an accrual method on their financials, there's going to be a pretty big discrepancy there. And I've seen that a lot in companies that have large accounts receivable, that have a spend that's maybe a little bit longer. And so we understand how that works, and we can back into, okay, yeah, I see how these would jive. There are times when we look through and we say, something's wrong here.
Right.
It's sure nice to have a CPA firm that knows what they're doing, that just say, well, yeah, here's the deal, and here's why that made sense to report it that way, or hey, we weren't working with them back then, but we are now. We're going to fix that issue. But yeah, it is important. And the other piece that we look at is the projections, right? I mean, you probably help put those together, but a lot of times they're coming to us because they're wanting to expand the business, or they're wanting to get into a new business line that they haven't done, and so we need to be willing to and look at the pro formas and see, do those make sense? Does it seem like they have the capacity to do what it is they're wanting to do here? Yeah,
no, that's awesome. When I discuss, and I'm not a lender or a banker, but when I discuss lending to people, from my perspective, I see it as a loan having two major components. It's the collateralization and then the debt service. And the collateralization is typically either something you can touch, a physical asset or something like that, or the promise to pay, or maybe some intangible asset like future cash flow or something like that. But those are two of the components correct for collateralization generally?
Absolutely.
Is some asset in your promise to pay
That's
as
right.
an owner?
That's right.
Okay.
Yep.
And then debt service is also then in there as well as the other component. And that's where you're looking at the cash flow to make sure they can serve the debt.
That's right. And then I guess the final piece to that is the net worth. So what have you done over your career, over your lifetime? Have you socked it away, or has it all flown right back out the door? Are we early in your stage and you're on a growth pattern, or are you kind of at a pattern where you want to continue on at where you're at and maintain that? And what's happening to your business net worth? How much is being retained at that level, but also at the personal level? How much is being retained, and how do you manage your personal affairs? So
right.
we look at that piece on top of the two that you suggested. And to us, that's a big piece because it tells the longer term story.
Right.
And you can't have one without the other. We have to know it all, but those are definitely the three areas we focus on.
So if I take a big distribution to go buy a brand new razor, are you okay with that though?
It depends.
If it adds to my note, I know I'm buying a depreciating
I like
asset.
it better when it goes into a CD in my bank, but you know.
Well, we can't have it all, right? All right, well, thanks. So that's kind of the general gist of the qualifications financially. Tell us a little bit about some of the basic business lending options. I mean, there's a ton of things that you can leverage. Going back to the components, right? Asset, promise to pay, and then your debt service. Talk about some of those asset components then.
Yeah, I mean, in this market, in this area, a lot of it's real estate. So
Okay.
whether it's owner-occupied building, so you're wanting to build a building for your CPA firm and operate out of that versus paying rent to somebody, or could be just an investment property like the one we're in right now. I mean, multiple tenants and redoing a use of a building that you'd hate to see go down. We love doing those kind of projects. Okay. And so the real estate gets pledged, the cash flow off the real estate gets pledged through assignment of rents. There's different ways to secure those collateral positions, but we do large equipment, we do new commercial construction, residential construction, and those are very hands-on. Those projects, you know, we're doing draws and we're seeing it go up and we're inspecting it, and it's very hands-on time with the borrower where we get to know each other pretty well. I think you're smiling for a reason.
Well, I'm just laughing a little bit because, you know, you look at construction loans and you're really kind of floating some money out there on a dream, right?
Yeah.
You know, because you got a hole in the ground, you got foundation, you got some sticks, it's still worth zero.
Yeah.
No one's going to buy that. Some would even say, I'd give you, less than what you paid for it because I don't want those kind of,
you customized it.
Yeah, exactly. Yeah. You already wrecked what I could have done.
Right.
You know, so it's just interesting because, yeah, there is some hope. I shouldn't say hope, it's probably not the right word, but there is some, I'm kind of at a loss for words, actually. But
well, there's a lot of unknown going into it because you're looking at the surface of this thing and you've seen the drawings, but the second the shovel goes in, everything changes. You know, there's something pops up, or oh, hey, we didn't know that there was this issue, and so going back to knowing your customer and having that relationship base, we got to be ready to roll with the punches, right? We can't go into a construction loan and assume that there will be no issues or nothing will pop up. And so we just need to make sure we're dealing with people that are passionate about what they do and want to continue on with this, and a builder who is willing to take it to the finish line and explain things and be there along for the ride. So yeah, but it's one of the most fun type of lending products too, because you do get to see something go from nothing to this awesome project that's being used for business and for good for the community. So I love it.
No, and you're right. And full disclosure, Quentin Leighty, First National Bank of Monument, has lent us the money to build our office building, which should be done in 3 weeks, which in contracting terms means 3 months. I'm not sure what's worse, contractors lying to us or us saying, we believe you. And you're about 4 months behind us, right? So we're kind of like in the same.
We better not be
similar
4 months. Depends on which terms.
Right, exactly. Oh, you're 2 months, right?
Yeah, that's right.
According to the contractor. So you talked about some real estate, and how many of your banking loans for businesses are leveraging real estate, you think?
Probably 70%.
Okay.
I mean, it's significant.
A big chunk.
It's a big portion of the business side, and it's driven by the market that we're in. I mean, we have real estate that's growing in this area. There's people coming in. We need more real estate, and those are markets that every project is just very different with the tenant mix that's coming in, or what the community is going to use it for, and so those don't lend themselves well to a large banking relationship, and they don't want to deal with a small project, you know.
Right.
And so that's where we really
$1 million building to maybe guys like you and I is like, that's a big project.
Right.
To somebody else might be like, we'll pass.
Exactly.
There's not enough zeros behind
That's
it.
right.
So how does somebody then borrow from banking to purchase? Let's say I'm a brand new CPA. I don't have any real estate. How do I go out there and buy a small CPA practice without having real estate?
Sure. So we have those product lines too, and those can be carved in different ways, but the reality is you're buying someone else's book of business, and there's going to be some portion of that that's not going to stay around, right?
Right.
And so we're going to look at projections with you, and we're going to make sure you've got the staffing and people in place to handle the new growth that you anticipate taking on. But we're really looking at a future cash flow stream there, and how confident are you and us that you can achieve that, and then also what's plan B. So if we hit some major bumps in the road, is there another source of repayment like your existing practice that's maybe it's doing well enough that even if this isn't as successful as you thought, it's going to continue to push you through and get you where you need to be? Because in the banking space and in financing in general, there's a spectrum of risk that you can go down. A bank's going to be the least risk taking entity you can work with. Sure. Because we have FDIC insurance, we have depositors to protect. And then you've got your hard money guys over here who just want the property anyway. Right, they don't care, but you're going to charge you a big rate, but they'll do it. And so we're talking about the spectrum that's the low risk. You've been doing business for a while, you're looking to expand. That's when we get involved, and we can help through looking at projections and looking at what you've been doing and make sure that we feel confident and that we're willing to take a risk on you. We want to know that our business owner is really passionate about what they do and they want to continue to push forward in this, and that they're really competent, which is kind of important, and character. Community banks look at character. So you'll never see in a write-up of a huge project, well, the character of this owner is great, because a lot of times they're out of the picture anyway. Right. Then we look at, well, here's what they've done, and we saw them through a tough time, and they came out, they worked through it, and here's where they're at. And so we consider all those factors when we're making those types of credit decisions. Okay, well, that's great. When Tina and I expanded our business, we were in our basement. We had like 3 people working for us. I came home one day and I saw a bunch of cars in our driveway, and I'm like, we need to get out of the basement. So we went and bought 2 books of business. And I would say the one thing that we messed up on is that we were undercapitalized. Sure. Because now we had extra labor, we had all this extra stuff, we had rent now because we wanted to get out of the basement, all these extra expenses, and we didn't have the working capital that we needed. And that was kind of scary, honestly, So I'm assuming guys like you are looking at that, like, hey, what's the 90-day cash burn? What's your 6-month cash burn? Especially with a lumpy system like taxes where you don't get all your revenue sometimes. Seasonal cash flows. And we look at that, and we, at the end of the day, we're going in it with you. We're partners on this deal, right? And so we want it to succeed. We want you to succeed. Those are higher risk from a loss perspective for a bank. And so we do want to make sure you have a lot of capital going in, and we want to make sure that we have a confidence level that, if we get a little tight on capital, there's another avenue to go to help you continue on to get through that kind of tough period when you start something like that, because there's always things. What do we not know that we don't know? It's that piece. And so we've done this for 100 years plus, and we still have unique deals. And so we always just try to build in some cushion to be able to handle whatever gets thrown our way. Well, that's kind of fun that you said unique, because I do, I guess, value that, appreciate that about business banking, community banking, like you, is that not every deal is the same. Every deal's got uniqueness to it. It needs some extra thought and some extra, care, I guess, and a lot of that stuff. How does somebody go about getting a line of, thinking of like lumpy, bumpy revenue, line of credit, how's that work then? Yeah. They'll meet with one of our loan officers or myself and bring in the financial statement, the tax returns. Should they match? They don't have to match. We're just going to reconcile and see where the differences are. And then tell us what the plan is. I mean, what's causing the tightness in cash flow, or what is it that you project that's going to trigger this need for this cash inflow? A lot of times we'll take inventory or receivables as collateral, or even equipment. So there's a lot of companies in the area that have a lot of equipment that maybe they own it free and clear. And that's not a bad strategy, but then they get some tight cash flow through some growth or something, and we can leverage those things. And we actually kind of like the big equipment. We get to go do inspections and check them out and see how they're taken care of. And so there's a multiple ways that we can take the collateral as our plan B to help get that capital infusion so that they can make it to the next step.
Okay, yeah, that's great. I lost my train of thought there on when you talk about the big trucks and equipment and all that. I'll have to come back to lost my train of thought. Talk to us a little bit about your BizAc, your business acquisition lending. We talked about that already a little bit.
Sure.
But now you're looking at 2 financials, 2 tax returns, all that stuff. Do you just look at the math? Do you look at culture fits between the acquisitions?
So that's where we spend a lot of time in our discussion, but it's hard because you can't analytically show that, but it's so real and it can make all the difference in the world. The numbers can look great, but if the cultures don't line up, and we've even seen that on our side when, as an institution over years, we've bought a bank, we've bought a branch location before, and we've passed on a lot of them over the time because of the cultural piece, because it is such a big portion. So the numbers have to work. But then that cultural thing is really a discussion with our business owner that we know because we have a good relationship with. And we talk about kind of the hard things like, are you sure this makes sense? And then if we get the confidence and they have the confidence after those tough discussions, then we check that box and say, okay, it sounds like these are going to be a mix.
I say that because I made that error. I'll be the first to admit. When Tina and I went out to acquire 2 books of business, we had one from a younger guy. He was probably late 30s, early 40s, and one was retiring in his 60s. And what we've discovered, at least in those examples with a personal service business, is that you're buying that person's peer group.
Yeah.
So the 37, 42-year-old, all the clients were younger, they were hipper, they were used to technology, they were used to higher fees as well. Yeah. And then the older one, the exact opposite. And it was a mismatch of culture. And it kind of hurt, honestly, because we lost a lot of the business that was coming, or that was supposed to come with us, didn't come with us, and all that. So I mean, it's a big deal, and you can't, like you said, you can't reconcile that on a balance sheet. You can't reconcile that with financial statements. It's just talking to people, doing interviews. Is this the right thing for us? So
right.
Tell us about. This is what I did want to say. We see it from a CPA perspective when a business owner goes out there and gets a loan against AR, or they go out there and get like a payday loan on some invoices, sort of like AR, but not officially based on AR. And then they take all that cash out of the business for themselves to live on because they got to pay bills and eat and all those things. It actually can become a capital gain. If you take a distribution in excess of your shareholder, and this is the S-Corp world, if you take a distribution in excess of your shareholder basis, it becomes a capital gain. And you can't add on debt basis unless you, the shareholder, are lending money to the S-Corp. So the bank lends money to the S-Corp. The S-Corp owner says, hey, it's Christmas, let's go spend it. And then all of a sudden they have a taxable gain. So that's kind of an interesting side shoot when that influx of cash comes in. Put it back in your business.
Right. Good point.
So how about IRA loans? You said that's on your list as well. How does that work?
Yeah, so those are unique. They're the IRS allows for borrowing at the IRA level, but there's some uniqueness to it in that it has to be non-recourse lending, which we don't do non-recourse lending except for in the IRA space.
Okay.
And so the way we mitigate that risk is a lower loan to value. So 65% maximum loan to value, you put in 35% from the IRA. So it's developed a lot of cash and you want to leverage that and deploy it. We have products that allow for that, and we're still going to underwrite the collateral. We're still going to want to make sure that it's a good investment for your IRA to have. It needs to cash flow a little stronger than something that's owner occupied. But it allows you to go further with your IRA if you're comfortable. Not everybody's comfortable leveraging their IRA, but it's a strategy we're seeing used more and more for planning.
We see it all the time too.
Do you?
Yeah.
And especially in, we've been seeing it more heavily in the bigger metro areas. We're not seeing it as much in the agricultural markets as we are in like Denver or Colorado Springs, for instance.
Yeah, I mean, sometimes everyone's net worth is all tied up in retirement money.
Yeah.
And they need to leverage it for that investment that comes along. We see a lot of self-directed IRAs being used to buy a rental and, like you said, to leverage it, you know.
Well, and there are those of us that like tangible assets, you know. We want to, instead of our IRA being invested fully in the stock market or the bond market, to have something that you can go tangibly touch and feel and see who's benefiting from that, that's kind of cool. And so there's just more of an appetite for that, I think.
No, I agree 100%. I mean, you spread your risk. I mean, people talk about diversifying your portfolio, sure, but you also want to diversify your income sources.
Exactly.
You know, and if you have that rental or that gaggle of rentals, you have that IRA, you have other things coming in, it helps. So let's, we got a few minutes here, but let's kind of shift gears a little bit to SBA lending.
Sure.
I've done an SBA loan. I think they're a good fit for certain business owners in certain situations. But you tell, I guess, our viewers and listeners a little bit more about SBA lending.
Yeah, sure. And SBA loans, like you said, can be the perfect fit for certain scenarios. And we are we're a small business, and we are not fans of bureaucracy. And so we haven't enjoyed our SBA loans that we've done in the past. We're answering to the government, we're going through their hoops, and we're filling out their forms. And then when you actually need them for anything, it gets challenging. And so our take has been, all right, we're going to let others play in that space. Really, that's not where we want to operate. We recognize that there's some great products and that can be the right fit for the right scenario, but that's not the space where we like to play. So,
it's like being an expert in it, right? There are certain banks who are really good at it. They have they know exactly what the regulations are, the bureaucracy, all that stuff. Why do you want to learn it every time? Yes. Because you only do it once every couple of months.
And
or something.
what we've found is we have a lot of success with people who maybe have done it before and they're like, I'm not doing that again. And then I think some of the biggest hurdles and the challenges that really make business owners not want to go back that route. First of all, they're very costly. They can be very costly from the fee standpoint. There's a guarantee fee that can come into play. There's servicing fees. There's upfront just cost to it. The offset is they get really good long-term fixed rates, but there can be handcuffs put on them. So there can be additional collateral that gets pulled into the pool. So not just the asset you're wanting to work with, but let's go ahead and grab everything you've got. So we've seen that cause problems. And then there can be big prepayment penalties too. Some yield maintenance agreements, which can be unbelievably high, and they can be zero too, but more often than not, you realize they're there when you really can't afford to do that. But also some of them have prepayment penalties as long as 10 years. Yeah. And so in a business that's growing, and a lot of times SBA programs are for newer businesses or for startups, to have the handcuffs on where you can't refinance or you can't sell that property because you've outgrown that space and there's a better option over here, that's where it really gets to be a challenge for those owners, and to try to unwind them can be so costly that you can't do it. And
so if you were to give one or maybe two pieces of advice for those who are considering that SBA, and let's say they've gone to their community lenders and for some reason it's not a good fit, they can only do SBA, or if that's one of the better options, let's say, what are a couple of suggestions when entering into SBA
I think
borrowing?
Just make sure you know what the long-term implications are of that.
So stress tested at like 2 years, 5 years.
Yep.
If I want out, how does this work?
Yeah, because you've got a business plan and you know where you want to go. And so if you run down that road and say, let's assume I'm going to be successful because I think I am, well, how does that line up with the debt that you've put into place on the front end? And do you see a potential clash there? And if so, you might want to double think it. The other piece to it is, if you go that route, how, kind of understanding what the other options are. If you do, let's say you exceed your growth projections and you've bought a piece of real estate and you're splitting at the seams, did you leverage that so much that you can't do the next step because of the huge debt load there? Yeah. And so if that's the case, have the strategy of socking away cash as quick as you can with that growth, which is hard in a growth spurt to sock away cash. So It's just really understanding the documents. I think a lot of times our borrowers come to us after they've done an SBA loan and they're surprised at really what all that entailed.
Yeah.
So just knowing.
I am. I remember when we had ours and we were looking to sell a couple of our rentals, we had to, kind of subrogate that loan and get some of that, paid off and all those little things that we had to do. So it can be challenging. And like you said, socking away cash, cash is king. Cash always puts you in a great spot, How are, just really quick, and we'll wrap this up, but how are the interest rates with SBA versus your local community bank? Generally speaking, I know that's probably a huge.
There's a lot of programs, and a lot of them allow parameters, so you can price it with a maximum of a spread over prime. Now, in their fixed rate, like the 504 program, where they go into second position, they offer a very long-term low rate option right now, and it fluctuates with market rate.
504 is with real estate, correct? Is that?
It's right.
Okay.
It's right. So owner-occupied buildings, so 51% or more. The community bank that you're working with or the bank that you're working with comes in first position at 50%, and then the SBA comes in with 40% behind you, and that's a fixed rate chunk, that 40%.
Okay.
That one can have some prepayment penalties and some other things tied to it and some upfront fees, but it can be a really good long-term fixed rate product.
Okay.
And the community bank's in first position at 50%, so they've mitigated their risk if it's a little bit higher risk.
Yeah. Yeah.
And it's 10% down, so that's where the SBA is really advantageous. There's less cash that's needed up front, and when you're starting a business and you see, hey, we project this thing to really go, your working capital is important, and so it does allow for that. So there are scenarios where they're great.
That's great. Good. Well, thank you. Just to recap, we kind of talked about the qualifying world, financials versus tax returns. You're going to reconcile those differences anyway. Find how much cash that we have available to service this debt. Looking at the components of lending, at the collateralization, your asset, whatever that is, your promise to pay, then the debt service on top of that. Some of the basic business stuff that we reviewed, real estate's huge, like you said, 70%, I think you said, something like that most of your lending is going to have real estate as its asset lever, if you will. And then of course, inventory and accounts receivable. And then we also have some IRA stuff that we can work with as well. So thank you for joining us.
Yeah.
My name is Jason Watson with the Watson CPA Group. I shouldn't say that. Now we're WCG Incorporated. We just got done doing a name change. Quentin Leighty is with First National Bank, and it's always been First National Bank,
That's
or
right.
at least no name change recently. We're here at the Axe and the Oak. This is our Bourbon and Business series of our podcast. We do thank the fine folks at Axe and the Oak and letting us use their area for filming and for recording this. And we'll talk to you real soon. Thank you.